So you're getting closer to retirement and everyone is giving you their opinion on when you should apply for CPP and OAS. And you find yourself not knowing what is the right decision. I mean, I get it. Throughout your entire working life, you've been contributing a sizable portion of your income. And now it is finally time for you to get some of that money back. Now, there are many arguments as to when is it best to start taking your CPP and OAS. But the common assumption at the end of the day is that you would want to maximize the total amount of money you'll be getting and avoid the government's clawbacks as much as possible. Hi, my name is Koby Lerner and I'm part of one of the top wealth management teams in the country. We focus on helping our clients build wealth in the most tax efficient way. So if that's something that you have interest in, make sure to subscribe so you don't miss out any of my future videos. And also make sure to like this video if you do find it helpful. It really does help with the YouTube algorithm. In today's video, I'll share with you 3 extremely important questions you should always ask yourself before deciding when to start taking your OAS and CPP. So let's jump right in. Now, the 3 main questions are: number 1, how long will I live for? Number 2, what are my income needs? And number 3, what will be the tax liability when my RSP converts to a RRIF account? Now, before we answer these questions, let's look at the facts and figures for the CPP and OAS. The Canada Pension Plan is a monthly taxable benefit that replaces part of your income when you retire. If you qualify, you'll receive the CPP retirement pension for the rest of your life. And the amount of CPP you get depends on the age you started your pension, your contributions, and your average annual earnings. And while the calculation of the CPP benefits is more tedious, an easy way of estimating it would be to take your best 39 years of earnings and compare it to the yearly maximum pensionable earnings, or YMPE. So let's say, for example, in 2004 you were making 20K in gross income, you would get half of the contribution for that year, since the YMPE was at 40,000. And if you'd have made 40,000 or higher, you would get the maximum contribution. Now, assuming you worked for 39 years and each year you earned above the YMPE, your CPP benefit at the age of 65 would be $1,175 per month. And if you were to apply at the age of 60, the benefit would be reduced to $694. If you choose to defer your CPP payments until the age of 65, they will increase by 7.2% per year. If you defer the payments beyond the age of 65, they will increase by 8.4% per year. In other words, if you were to defer your CPP payments to the age of 70, your monthly benefit would be $1,800. The Old Age Security Program, or OAS, is a universal retirement pension available to most residents and citizens of Canada who have reached their 65th birthday. And the eligibility of the OAS is straightforward for most Canadians. If you turned 65 this year, your OAS monthly benefit would be $613. And just like the CPP, the OAS is indexed to inflation. However, if your income exceeds 79K at your retirement, your OAS starts to get clawed back. In other words, for every $1,000 above this threshold, your OAS annual benefit is reduced by $150. If your income is above $123,000, your OAS gets completely clawed back and is reduced to 0. Now that we're all on the same page, let's circle back to the first question. Why is it important to estimate your life expectancy? Well, the CPP payments stop as soon as one passes away. And the shorter you expect your life expectancy to be, the sooner you should apply for your CPP. Now let's take David and Patricia, both 60 years old and are eligible for the maximum CPP. David decides to apply right away, while Patricia waits until the age of 70. David receives $684 a month or $8,000 a year, and Patricia, on the other hand, receives $1,800 a month or $21,000 a year. And if both were to die at the age of 72, David would have received almost $100K, while Patricia would receive only $44K. David is obviously better off in this scenario, earning an extra $66,000. However, if they were to live to the age of 80, Patricia would be making $50,000 more than David. Now, the second question you need to ask yourself is, what are your income needs at retirement? Now, if you don't have enough income to cover your lifestyle expenses, then applying for the CPP is, as early as possible, is a no-brainer, as it becomes a necessity. David and Patricia, however, both had accumulated investments to supplement their retirement. Now, assuming that the same lifestyle needs, because David had applied for the CPP at 60, he withdraws $8,000 less per year from his investments. And with a 5% rate of return, his investment portfolio will have an extra $110,000 by the age of 70. Now, assuming the 5% rate of return that Patricia is not earning on the money that she used from her investment to replace the CPP income, it will take her until the age of 80 to catch up to David. And from that point onwards, Patricia will be better off. Now, the third question you need to ask yourself is what your tax liability will be on your RRSP at the age of 71 when it gets converted to a RRIF. Now, let's assume that David and Patricia both have $40K in other pension income and $500K in RRSPs. Now, because David is receiving the CPP, he leaves his RRSP untouched and growing at 5%. In the year he turns 72, David will have accumulated $897,000 in his RRSP and now has to make minimum withdrawals of $47,000 per year from his RRIF. This will increase David's taxable income to $87,000 and his OAS now getting clawed back. Patricia, on the other hand, takes advantage of a lower income and withdraws $8,000 a year from her RRSP to supplement her income. By the time she turns 72, she has $758,000 in her RRSPs and her minimum withdrawal is $39,000 for a total of $79,000. She effectively avoids any clawbacks in her old age security. In conclusion, deferring your CPP can be very beneficial in certain circumstances, especially if you have a long life expectancy. However, keep in mind that everybody has different circumstances, and in order for you to know the best strategy, contact your financial advisor. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button. And if you want to see more videos like this one, don't forget to subscribe to my channel so you don't miss out on anything important. If you have any questions or if you want more information, leave a comment below. Thank you very much for watching, and I will see you next time.